Hello, everyone, and welcome to another Maine SBDC webinar. My name is Kelsey Reardon, and I am with the state office hosted by the University of Southern Maine right in Portland. And today we have again Maine SBDC at CEI Center Director and Business Advisor Raynor Large to go through selling your business. So yesterday we talked about buying a business. Today we're talking about selling it. So every business has a lifetime. They sometimes get passed on, sometimes they don't, but understanding your options are super important as you're going along in the life of a business owner. So today, Raynor's going to be covering things to keep in mind if you're getting ready to sell your business. If you have any questions along the way, go ahead and stick them in the chat below. He usually answers the questions as we go, but we'll definitely be able to answer anything by the end. If you have any additional questions in the future, feel free to respond to any email you've ever gotten from me. It'll end up in the same place, but I will be sending out a follow-up email probably tomorrow morning that will include the slides as well as a link to the recording and any other information we want to share. So we make a lot of our contact information is in there, Raynor's email. If you're not set up with a business advisor, we highly recommend it. The Maine SBDC stands for the Small Business Development Centers, and we are a national program. So each state has a bunch of centers, and each center has a bunch of advisors, and we can help answer your business questions. And if we can't, we can find someone who can. So getting set up with a business advisor is a great idea. And there's a easy link to sign up in my follow-up email, but there's also a big orange button on our website that you can click if you don't want to wait till tomorrow. Like I said, use the chat if you have any questions along the way, but otherwise I think we're ready to get started. I'll pass it over to Raynor.
Perfect. Thanks, Kelsey. And thanks everybody for being here. I know it's a beautiful day outside and we haven't had many of those recently. So I admire your dedication to showing up to these online webinars. If I see your video turn off, I am assuming that just means that you're going to move outside for a bit and catch the sun while you can. No judgment here. So certainly appreciate that. So we're going to be talking about selling a business today. And we're going to dig into a couple of different things and look at a couple of things, but I did want to start from the beginning, which is reiterating what Kelsey said, and that I tend to get excited and talk about a subject that I really enjoy, which is business transactions and transitions. And so if I miss your question in the chat, or if you have a question that's pressing, please take yourself off of mute and interrupt me. I think if you have the question and somebody else in this conversation also has that, and we can dig in. Like Kelsey mentioned, a lot of our work is one-on-one. That's our primary method of service. So that's what we prefer. So if this turns into a conversation about your business or what you're thinking about, and that is more helpful, then that's absolutely what I would prefer to be doing rather than just going through PowerPoint slides. So please interrupt me. That said, I also understand that what we're talking about is sensitive, right, and confidential to some degree. So we'll include my email in the follow-up if you have questions that you're nervous about sharing with the group or you prefer to have in that one-on-one setting. Please don't hesitate to reach out. That's exactly what we're here for. It's a no-cost service. It's free for you, subsidized by the federal and state government and local host organizations. So no cost to reaching out and asking those questions. Otherwise, just ask that you keep yourself on mute if you're not asking questions so we can get through. It's a lot of information we're going to talk about today. My background, just so you're aware, I have been a business broker in the past. I have done buy-side and sell-side transactions. I'm credentialed through the International Society of Business Appraisers. At this point with the Maine SBDC, I've helped more than 1,000 small businesses in the state of Maine. I've also, in wearing a different hat, done more than 100 business opinions of value or valuations. So I'm very practiced with that aspect. And I've seen a fair number of unique and interesting transactions, but a lot of the core concepts that we're going to talk about today are universal. And that's really what I'm trying to bring to the table is some of those principles for your understanding as you're possibly approaching thinking about selling, or if you have a buyer in mind and are looking for more tangible next steps. We'll also talk about that. So we'll talk about, I'll set some expectations of what I've seen in Maine in particular. We'll talk about identifying what you're selling and how that's structured. We'll talk about identifying potential buyers and negotiating that and discussing with them, seeing the transaction through their eyes so that a reasonable accommodation on price can be met. We'll talk a little bit about valuation. What's the focus of today's conversation is what I call Main Street businesses, which I differentiate from middle market, right? So Main Street to me is the crux of what we deal with here in Maine. It's the business that does, less than $5 million in sales, probably has 10 or fewer employees. You drive down Main Street and you see them, right? That's what it is. Middle market is usually referred to as a business that has 10 million plus in sales. And there's a slightly different approach there, where an investor in a middle market business is really looking at a return on investment. So there's different valuation approaches that way. You might hear of like a modified cap rate approach or a discounted cash flow. That's really middle market. The focus of our conversation in this webinar today is on Main Street, which is that identification of who are the local buyers who are going to step in and run the business as it has been run, replacing you, in essence, as the business owner. And what is a reasonable price that they could achieve in borrowing or bringing to the table to buy that business and replace you and still keep the business running. So when we're talking about value, a lot of that is the value that is created, that you've created, the demonstrable value, that is transferable to the buyer, and creating either debt or equity, but putting that business in a position to continue to succeed, right? And not creating so much debt in that purchase price that the business cannot succeed with the historic cash flow. I understand there's a lot going on there, and we'll dig into it, but that's that middle section. We'll also talk a little bit about structuring the deal, different opportunities there, and then preparing to sell. So best practices. So if you're a year, 2 years out, that's wonderful. These are all things that you should be thinking about. And I'll give you some kind of tips or pointers on how to prepare for that eventuality. So first, I wanted to set some anecdotal expectations. So up until about a year into COVID, I was an active business broker. I still have my license, although I don't practice. And this is what I see in business brokerage, unfortunately. So it's not like real estate, right? So about half of listings that are brought to market looking for an external buyer end up selling. And of that 50% that sell, it takes between 12 and 18 months to get to close, right? The reason I like starting with this, unfortunately, is that it's very different than real estate, right? If you wait until that tipping point where you go in and you have an argument with an employee and you think, that's it, I'm done, I'm out, you're really limiting yourself. Or you go in and the coffee machine doesn't work and you're like, that's the last straw, right? So if you're waiting for that final kick to go out the door, you're really limiting yourself. And so the more in advance that you have to look ahead and prepare and take the steps, the better of a position you're putting yourself in. And then this last piece that I want to draw attention to is that if you have created goodwill, if you've created a real intangible value in your business, and we'll talk about how you calculate that and what the consideration is there, more than half of businesses that get sold that I have worked with to transfer that value involves some form of a seller note. So if you think you're just going to get a check at closing, and you want to maximize the value you get out of it, you might end up needing to hold some portion of a note or have some agreement in place. Not all the time, not 100%. We'll talk a little bit about, structuring the deal around that. But again, just want to preface that if there is that intangible value without collateral associated with it, that's wonderful. That's the work that you put in to create that value is finally being recognized. But it might take a little bit longer to get that value back out of the business than you anticipate. So what are you selling? Right. So this is the first question that I always lead with. So you are selling, in essence, the ability of your assets to create reliable cash flow. Right? And highlighted a couple of things and we'll dig in. So assets, that's the first pushback that I usually get. Oh, you're probably going to do an asset sale. And people say, no, it's not a liquidation. There's goodwill value. I have policies in place. Assets include both tangible and intangible assets, right? So an asset sale includes both. And the distinction between an asset sale and what you're probably thinking of, which is called a stock sale, is that an asset sale is a new company buying a list of assets, and that's tangible and intangible assets. So the buyer comes in and says, I formed this LLC. This LLC is going to purchase the furniture, the fixtures, the equipment, the business name, the website, the customer list, historical financials, social media accounts, right? So all of those intangibles that you've created, the value, they're still assets, right? It's included in that asset purchase. A stock sale is rare at the Main Street level. A stock sale is when somebody comes in and says, I want to buy 100% of stock ownership in your business. It's more convoluted, right? Because it's not a new company buying a list of assets. And so usually there's more attorney time involved. There are some benefits around it if you have long-term contracts that aren't assignable, or if you have like work in progress. There are things like that where a stock sale might make more sense, but usually an asset sale is cleaner. New company buys this list of assets from old company gets paid, liquidates their liabilities, closes the books, right? So I just wanted that distinction. So the ability of your assets, right? So we have the assets that are being transferred. We've created that list. Now, transferable assets are saleable assets, right? And I jump to the bottom question here. When was the last time you took vacation? Because if you are inextricable from your business, then you are the business. And that's been wonderful for however long you've been in business. But if you can't transfer that, then it's not an asset that's sellable, right? A buyer can't buy that. So what can you do in preparation for that transition? If you're in a place where you can say, yeah, every summer I take 3 weeks off and go to the camp, go up to camp with my family, and I come back and everything's fine. Great. You've been doing the right things. You've been pulling yourself out of the business. You want to be replaceable, right? You've created a business in essence, and a lot of the time there's an aspect to that where you're irreplaceable to the business. And there's a time period for that. The first couple of years, you're the business, right? You're running it. You're the entrepreneur or the face. As you get closer to the sale, you want to pull away from that, right? So standard operating procedures, checklists, tasks, management structure, recipes, whatever it is that you can put in writing, so that at the day of close, you can say, here, do this. Don't pick up the phone and call me, flip to page 40 something. You find the answer to your question, right? Mondays, we do this. Tuesdays, we do this. First week, we do this. Third week of every month, we do this. Right? If that's transferable, if you can take all of your knowledge, all of your business acumen that you've created and put that in writing so that you can just hand that to somebody, then it is sellable. Let's talk about the second part of this, right? So the ability of your assets, transferable assets, to create reliable cash flow. So how do we define reliable cash flow? So a couple of things here. One, legal and demonstrable, right? And I'm not the IRS. This is recorded, but it's not reported on. We send it to you. So I'm not here to tell you that there aren't very effective tax mitigation strategies out there. And a good bookkeeper, a good accountant can guide you on how to reduce your taxable income. So if you're looking at your tax returns, it looks like you're barely breaking even. And you can add back to that to show cash flow, right? Happens all the time. And we'll talk about the different cash flows. But to do that, it has to be legal and it has to be provable. Right? So if you're talking to a buyer, you have to be able to say, this is the actual cash created by my assets, excess cash above and beyond the cost of operations. And I can prove it, right? Usually people use tax returns to do that because a tax return is something that you've submitted to the IRS or an accountant has submitted to the IRS for you. So you have that kind of at least straight face test where you're like, all right, I'm being held accountable to this document. So buyers want to see tax returns. Buyers, accountants, and attorneys want to see tax returns. You give them the tax returns, but you can footnote them. You can say, hey, this expense is non-operational, right? Company vehicle, right? Not really necessary, but a great perk that I've expensed and I can add that back. Or education is another one. Or maybe you own the real estate and you've been charging yourself excessive rent to get that flow through tax benefit to your passive holding company. Perfect, legal, demonstrable, right? So have those things footnoted. But if you're a couple years out and you're looking ahead, maybe that cash payment makes it to the drawer rather than ending up in your pocket, right? Or maybe, employing somebody under the table rather than officially, it makes it to the books, right? So those things, they're legitimate. There's no moral judgment here. I'm not here to pass any judgment, but in order to add them back and show them to a buyer, they have to be legal and demonstrable. Usually footnotes or changes to your tax returns. And then historic consistency is the last one. So we'll talk a little bit about setting the table at the end and planning ahead. But if you have that leeway, 3 years, 5 years out from selling, to be able to clearly define which bucket expense falls in, clearly define your budget, annually, reduce your chart of accounts, which is how long your income statement is in your QuickBooks. Some of those things you can clean up and just kind of make sure that there is consistency year to year, that you tell a clear narrative of your business, and you can show that your assets are generating reliable cash flow. If you have a great year and a bad year and a great year and a bad year and 2 bad years and a decent year, that's going to make a buyer nervous. If you're showing 5% growth every year and your expenses are in line and controlled, it does 2 things, right? One, it says, okay, this business is reliable. And 2, the business owner who owned it knew what they were doing, okay? Knew how to look at the books, knew how to manage the accounts, knew how to run the business proactively and forward thinking. And that's, that shows in the policies, the procedures, the systematic approach, but it also gives the buyer confidence that what they're buying is clean, for lack of a better word, is well run, right? That they're going to be able to step in and the wheels won't fall off in the first week. So that consistency has, multiple benefits to it. So who's buying it, right? So we've got this concept of what we're selling now. We know, okay, we're using our assets, we're using them well, we're covering the cost of our operations, and we're showing reliable, consistent cash flow in excess of the cost of operations. Great, I'm doing well. Now let's look externally. Who's the buyer for this, right? Most Main Street businesses that I deal with are in these first 2 columns, right? It's either a staff or a family member, someone in-house, or an owner operator, right? Someone buying a job. And what's great about that is that everything's going to be fairly consistent pre-sale and post-sale. Right? They're stepping in and replacing you, 1 for 1, right? You for them. Now, there's also this 3rd column that I put in here. We're not going to focus a lot on it, but as a seller, it might be an option, right? And that's a synergistic buyer. And a synergistic buyer, if you think about it, is someone who's either a competitor looking to horizontally integrate by your footprint, your customer market, or maybe a customer or a vendor looking to vertically integrate, right? And that synergistic buyer, there are few of them. Right. That's the downside to a synergistic buyer, is you're talking about 5, maybe 10 potential buyers. If you're bringing something to market, you're really in that middle column. You're looking for that owner operator who's going to step in and replace you, or possibly, if you're not bringing it to market, but you're planning ahead, it's a staff or a family member that you're kind of grooming, bringing up to take over the spot. So that third column, few potential buyers, good upside though, right? Because if you think about that synergistic buyer doesn't care how well you're utilizing your assets. They don't care about your net income, your bottom line. What they're looking at is your top line. They're saying, hey, I have my own insurance. I've got my own org chart, my own accountant, legal professional. I don't care what you've spent there. I want your footprint. I want your customer list and your target market. And that's worth something more to me, right? Because these expenses I already have. If I ramp up my revenue by buying your footprint, my cost of goods continues on, but I don't have these overhead costs. So I'm dropping a lot more to my bottom line, right? So synergistic buyer, usually willing to pay a little bit more. Downside, far fewer potential buyers out there. It's usually specific to an industry, right? So that's another aspect to this. Synergistic buyer is usually someone who can absorb a book of business without adding a second location, for example. So like a law firm, accounting practice, right? Somebody who's really just looking at your customer list. So who's buying it? What they're buying is an important part of that cash flow conversation. Staff, family member, owner, operator, they're looking at your bottom line. They're saying, how profitable are you? How strong is your business? Synergistic buyers looking at the top line and they're saying, how big is your business? How big is your footprint? How can I expand by acquiring you? So, the first two are going to pay for it from the cash flow of your business, right? What is the cash flow that they're buying, that bottom line, the net income? The synergistic buyer pays for it with the cash flow of their business and your business combined. So it's much more of a poker game in that case when you're talking about price, because they've done their own analysis and they know what hand they're holding, right? And they're saying, okay, this is the value of the hand that I've got when I take some of your cards and some of my cards and combine them. The staff family member, the owner operator, you're selling them your hand, right? So you know exactly what it is because you've been holding it for 20 years or however long it's been. So what's in a cash flow? When I talk about cash flow, paid for from the cash flow, how do we define cash flow and how do you look at that? There's three names or, terms that get thrown around a lot. Net income, EBITDA, and SBD, right? So net income is easy to understand. That's probably what you deal with all the time. That's what you pay taxes on. So if I ask for your Schedule C or your tax return, I can look at the bottom. It says net income and it's got a number on, right? EBITDA adds a few things back to that. EBITDA is primarily what banks look at, essentially, because it's the free cash flow created by operations. So you start with net income, and then you add back two things, right? So depreciation, amortization, which is a tax strategy, essentially, but it's non-cash. That's the essential part there. So your business generates cash, and it shows an expense of depreciation, amortization. So your net income is lower than your actual cash produced, if that makes sense. And then we add back interest as well, because in the case of an asset sale, you have to remember that a new company is buying the assets of your company. And if that new company is a cash buyer, then they won't have any interest. Or if that new company is borrowing some money from a friend and borrowing some money from a bank, then their interest payment's going to be different than yours. So interest has been your cost of money to date, right? But a new company is going to have their cost of money. So EBITDA adds back, so it's equity, right? Net income before interest, taxes, income taxes, depreciation, amortization. So EBITDA is just saying what cash is available for the new business, the support day. SDE takes that a step further. So seller's discretionary earnings is primarily what's used when talking about Main Street businesses at less than 5 million, fewer than 10 employees, retail, restaurant, whatever it is, local, right? Your size company, my size company, what we work with. And SDE adds back two other things, right? So we start with EBITDA, and then we add back your salary, which fluctuates, right? Year to year, maybe you take some out, maybe you don't, maybe you just take it all as distribution. So it's shown in net income already. Maybe you pay yourself a lot. Maybe you and your spouse are both on payroll, but you're the only one who works, right? So do you add back both? Yeah, it's a discretionary earnings, right? And then that top part, discretionary spending. And that's where I really hammered that idea of, legal and demonstrable, right? You have to be able to prove that it's non-operational, that it is free cash for the buyer to use. And it has to be legal, right? You can't have illegal things on there, or, if you're taking a lot of cash under the table and not showing that on the books, the buyer's not going to pay for that, right? It's a pay now or pay later thing. You can either pay taxes on it and show it, or, if you pay taxes on it and show it, then you reap the rewards and get paid a higher price for your business, or you don't pay any taxes on it and your business is just worth the physical assets because there's no reliable, historic cash flow there, right? So some strategy there as you get closer to the sale. The more net income you have, the more you pay taxes, the easier it is to sell because you're showing substantial cash flow. You're showing that there's real value in the business, that your assets are really producing excess cash flow, right? So that SDE allows for some of those things to be added back, some of that tax mitigation strategies to show, hey, I don't pay as much in taxes because I've worked with my accountant to find these strategies, but they're reasonable strategies. They're legal. I can show you what they are. This is the cash that's available to you as a buyer. So that's why SDE is used, because it allows for some of those adjustments to be made. So that's what you're selling, right? You're selling your discretionary spending, you're selling your salary, you're selling your interest, depreciation, amortization, and you're selling your net income. That's the SDE. That's the free cash flow that you've created. And what is important to think about is what the buyer is buying. Right? So the buyer is buying that, but they're using it for three things. They're using it for their salary needs, right? So if I'm a seller and I've paid myself less than minimum wage for 10 years, and I go to a buyer and I say, don't you want to buy this business? And they say, well, how much do you pay yourself? Oh, sometimes I get as much as $5 an hour and I work 60 hours a week. What's the buyer going to say to that, right? No, thanks. I'll pass. I'm going to go work down the street for McDonald's and get paid twice as much as that. So you have to understand, what is the buyer's salary expectations? And we can use industry averages, or you can, talk to your manager or whomever you think is going to replace you and say, okay, what needs do you have? And then what that leaves is the cash available to debt, right? And debt, in this case, is the purchase price. It's determined by the purchase price, because there aren't buyers out there who are going to come to the table on $1 million business and just say, what is that, $1 million? How many zeros? Okay, here's the check, right? No, they have to get financing. They have to work with a lender. They have to work with some wealthy family member. Whatever it is, it's rare, so rare to have a cash buyer. I think I've seen one in 6 or 7 years. And they had a very expensive and aggressive accountant. So even though it was a cash buyer, they still did the same due diligence a bank does. They still did the same homework. So, the result is the same, in that your SDE, your cash flow, has to support the buyer's needed salary. And then what is left goes to debt support. And the debt is created by the purchase price, right? So there's usually a buffer in there, debt coverage ratio, where the bank says, okay, you've produced 150,000 historically in SDE. The buyer needs 50,000 as a salary. There's 100,000 left to support debt. We're not going to make a loan that requires principal and interest of 100,000. We're going to make a loan that requires 75,000, right? 1.25 debt coverage ratio, because we want there to be a buffer. We want to make sure if a piece of equipment breaks, that buyer can replace it, and we still get our principal and interest. That if an employee walks out and net income slips a little bit, we still get our principal and interest, right? So there's that buffer there. So that's what we can then use as a seller, looking at the market, looking at our cash flow, looking at how well we've done, to say, okay, we've got this ability to support debt. We know, the bank's going to look at 20 to 30% down. We know that the bank's lending at 7 to 10 years based on the quality of our equipment, which we'll talk about in a minute. We know that interest rates right now are between 8 and 9%. So, hey, we've got a supportable purchase price. Now, that supportable purchase price might not be anywhere near where you want it to be. And that's okay, especially if you've given yourself some lead time. Because you could also say, here's a supportable purchase price, here are the terms that are in the market. What does my seller's discretionary earnings need to be to get there, right? And that way you can say, okay, I've got 3 years, I've got to show this much in cash flow. How am I going to do that? How am I going to grow this business to achieve the sale price that I have in mind? Now, you can't ask for more, right? You can't go to market with a broker, even internally, if you have a buyer internally, and say, hey, you know what? The supportable purchase price is less than I want, but I want out, and I've got this buyer waiting and sitting right there and asking for it. I can still sell it for higher. But what you're doing is you're creating more debt than the business can afford, right? And so there's 2 possible outcomes there. One, aggressive growth. The buyer comes to the table and boom, bumps up the cash flow and is able to support that. They bring something to the table. That's the synergistic buyer, right? Is they're bringing something to the table to cover that extra purchase price. Or somebody who has a skill set or a talent or a customer list or whatever it is, that when they buy your business, they know they can achieve that. So a couple of things there. One, if you're holding a seller note and you're putting too much weight on the buyer that the buyer can afford, you're really betting on the buyer, because if the buyer fails, then your seller note's never getting paid. Right? So if you're involved in this, you've got to really believe in that buyer. Maybe not, though. Maybe you don't have a seller note. Maybe it's just a purchase price and you're happy with that. And so then it becomes a marketing play, right? Where if your historic performance doesn't support the purchase price, you could still sell it, but that puts a lot of pressure on you and your broker to be able to convey that upside to the buyer and convince them that it's worth it, right? So any questions? Sorry, I just noticed there's something in the chat. Okay, just Kelsey, I'll ignore her. So what we've got so far, what we've been talking about, so we know what we're selling, right? We've got our assets, tangible and intangible. They're producing cash. How do we measure that cash? We use seller's discretionary earnings. We look at historic cash flow. We make some weighted adjustments, right? Historic cash flow the last couple of years, probably all over the place. Hasn't been a consistent couple of years. So what is the narrative there? Are you able to convey that? And then we can use that. And if we have our sale price in mind, that gives us our target market, right? If we're saying, okay, our sale price is higher than the business can afford on its own, and we're looking at these buyer improvements, then we're looking for a buyer that is either synergistic, vertical, horizontal, whichever it is, or has a very strong skill set that I've been lacking and can understand the implementation of that skill set. All right, so trying to think of a good example. Sales, right? So I had a client, 6 months, half a year ago, probably, that they lost their key salesperson and they struggled for 2 years and were just missing. And their business was still productive, it was still successful, but then they found a salesperson in an adjacent business who was looking to hang their own shingle. And that salesperson overpaid for the business because it was a very easy plug and play. He said, hey, we've got this structure already formed. We've shown years ago that it can work very well with a good salesperson. We just don't have that. If you step in as an owner, you can run that, you can take over that position, and you can get back to where we were 2 years ago. And the salesperson said, yep, no, absolutely. I can do that. I see that. Now, they didn't pay what the business would have been worth 2 years prior, because that buyer still was looking at it and saying, well, I've got to come to the table. I've got to inject my sweat equity, my effort. But they paid more than the business was worth to a third party who didn't have that skill set, right? So if you've got that purchase price in mind and you understand that concept, then you can identify the potential buyers that you're going out and talking to. So what's it worth, right? So there's that internal methodology where you're saying, okay, this is my historic cash flow, and this is what debt my cash flow can support. I would also say there are these three methods that I like to use, right? So the ceiling is an important methodology. So if it's cheaper for a buyer to hang their own shingle, buy all the furniture and equipment that you have, invest in the LLC and the insurance and, first and last month's rent, stock the shelves with the inventory, and run at a loss for a period of time until they're up and running, then that's what they're going to do. If it's cheaper for them to do that, then they're going to do that. All of your goodwill, all of your effort takes 3 to 5 years to create on their own. And if they're looking at the purchase price that you're asking for and they're saying, well, geez, you think it's worth $1 million, but I know for 800,000 I can do this on my own and carry some losses for a couple of years and still come out the other side. Why would I pay $1 million? Right. So that's the ceiling. They're saying, okay, what is that alternative? And is my excess cash flow worth enough that ceiling is too high and that my value is a reasonable value for the purchase? The floor, right? That situation where you have that employee fight, the coffee machine breaks, you're using the bathroom and there's no toilet paper and you just throw up your hands and you say, this is it, I'm done. That's fine, right? That happens a fair amount. You can sell your asset value. That's the floor value. And in that case, when I say assets, sorry, confusing, I know, tangible assets, right? You're just saying, okay, I'm flipping that sign from open to closed. I'm posting my equipment on Craigslist or Facebook. I'm going to sell it off. So, market price is that middle portion. And that's that conversation between you and a seller or you and a buyer, where you're saying, this is what I think it's worth, and this is what they think it's worth, and we meet somewhere in the middle, right? Market price is essentially what a buyer and a seller agree upon in their arm's length transaction. And it can be anywhere between those two values, ceiling and floor, right? So that's that conversation of, okay, this cash flow can support the debt. We can structure it so that it works. I've created these tangible assets that make my intangible assets transferable, right? I've put in place these policies, procedures, and I can demonstrate historic cash flow. So I'm able to converse with a buyer and the buyer's accountant and the buyer's attorney and the buyer's broker to say this is the value and convince them of such with that documentation. Now, if your market value, that value that you're able to convey, is greater than the tangible value of tangible assets, what you've created is goodwill. So that goodwill, what gets thrown around a lot as, the catch-all for everything that's intangible, is essentially the market value above the physical value of your tangible assets. Right? You're saying, hey, a buyer and a seller have agreed that there's more value here than just the furniture, fixtures, equipment, inventory. And, we've talked about this, but if it's worth more than that, then the business has to be able to pay for itself, right? Because the buyer can't be expected to reinvest. The buyer can't be expected to lose money making their monthly debt payments. If I go back to this, right? So that debt support, if your actual purchase price is more than the supportable purchase price, if you look over on the left there at that green, what gets moved? What of that gets absorbed in overpaying? It's not the debt support. The debt support goes up. And if historic SDE stays the same, if that's unchanged, the only other thing that moves is the buyer's salary, right? So at a certain point, the debt exceeds what the buyer is willing to pay themselves after a period of time, right? So if the buyer isn't able to grow the business aggressively, all they're doing is working without paying themselves. That's not sustainable. I know there are periods of time where you, as a business owner, have probably done that and you didn't want to, right? So asking a buyer to do that is a tough conversation to have. So what about multiples, right? This is this conversation we have all the time. Someone comes in and they say, "Oh, my accountant told me it's worth 3 times my top line, or twice my net income." Right? So, okay, well, what does that mean for the buyer? Does it, is that reasonable to expect the buyer to be able to purchase that? And it is a good starting point, right? So if we go back to one of those first slides and we're talking about that staff person or the family member, and you're like, hey, we're on good terms. We're willing to work with them. We just need a starting point. We just need kind of an idea of what this is worth. Okay, a multiple might work for them. I would say that, you'd use a bottom line multiple in that case because all the expenses are staying the same. So you're really focused on that cash flow. But there's still a lot of room for negotiation, right? Because it doesn't take into account what is expected for inventory. It doesn't take into account how old the equipment is. It doesn't take into account, what so SDE, right? Are those add backs reasonable or unreasonable? Are they demonstrable or unprovable, right? So if you're, in that position where you're using a multiple, make sure you understand the nuance behind that and what is included, what is excluded, what is added to that multiple to start that conversation. Great starting point, sure. A lot cheaper than buying a valuation or having, a broker opinion of value report done up for you, but it leaves a lot of unanswered questions. And then, like I said, usually there's top line multiples and bottom line multiples. The top line multiples only applicable in that synergistic industry, the attorney, the lawyer, accounting practice, whatever it is, medical practice. Most businesses, 95% of the businesses we deal with, you're looking at that bottom line multiple where it's okay, all the expenses are going to remain the same more or less. And what is the cash flow left to support the debt? That's the multiple you use to then determine the value of that operating system, right? So we've got a price. We've talked about that. You've negotiated with the buyer. You have kind of a timeline in mind. You've created an asset list, tangible and intangible. How are they going to finance it? Right? And we've alluded to this a little bit, but working with them to understand their financing and help them will help you get the most value out of the business. Because commercial banks, right? You probably work with commercial banks. They're all FDIC insured, which means they have pretty strict guidelines about how long they're willing to wait to get paid back, what kind of collateral coverage they need, what credit score expectations they have, right? So that's great. A buyer will often use a commercial lender for a base of the purchase price, a piece of it, whatever is collateralized, whatever is supportable by historic cash flow. But if you've agreed upon a purchase price in excess of tangible value and the buyer doesn't own a home or doesn't have much personal assets or doesn't have $50,000 to put as a down payment, then there's more room for discussion, right? Because if you're limiting them to a commercial note, then you're limiting yourself to the purchase price supportable by that, right? So if you want that value above and beyond that, the buyer is usually asked to do a personal guarantee, which secures all of their assets, right? You might be asked to hold a seller note in a secondary position of the bank, which means you get paid after they get paid. Or you might be asked to stay on as an employee or a contractor for a period of time, help some of that knowledge become more transferable, right? That would help you, it helps the business, and you get paid for a period of time after that. I had a flower company, so a while ago, but he got paid, a lump sum, and then the business paid him $7,000, I think it was, on 8 holidays for the first year. And it was an hour phone conversation the week before the holiday. And for that hour phone conversation, he got paid $7,000 for each one of them. So they put $50-some thousand as part of the purchase price in this agreement that before Mother's Day, before Valentine's Day, before, whatever it was, Memorial Day, he, transferred some of his knowledge and was available to the buyer. And that was a great way for them to kind of find some additional value and work that into it. So there are ways to get that value out of the business, to capture some of what you've created, that doesn't burden, the buyer 100%. We've also done, I've also seen like a flexible purchase price based on future performance, right? Again, that transferable knowledge, the consistency of saying, okay, just again, sales was actually a great example in this case, where one of the seller was the key salesperson, and they stayed on for a period of time and transferred the key accounts over. And in order to do that, they got paid their lump sum up front, and then they got paid a commission on the sales for those key accounts for the first 2 years. And that was a way that the buyer was like, hey, you got a lot of eggs in these baskets. I love the idea of paying you what you think this business is worth, but I have to make sure that these clients stay with us. So, you stay with me, keep this phone, they'll contact you, you'll sell to them. I'll keep that and I'll pay you by 2 or 3% of whatever the billables are. And the seller said, sure, I like these guys. I've worked with them for 20 years. I'll keep that relationship. I'll bring my cell phone down to Florida and you can pay me monthly. And it worked out really well. So there are those creative solutions as well, but that takes negotiation. It takes a starting point. And then it takes understanding the structure as a whole. So, okay, this is what can be leveraged up. This is what the buyer can take to the table. We've agreed upon a price higher than this. You, as the buyer, think it's worth more. I, as the seller, think it's worth more. Where can we find that money? How does that work? So let's take a step back, right? So let's say we're a few years out, and I hope that's the case where you're giving yourself some lead time. So preparing to sell. So the first thing I would say, going back to that, standard operating procedures, is make yourself replaceable. Take ego out of it a little bit. I know it's fun to be the business and be the face of the business, but you have to make yourself a non-entity. You can leave the business for months and come back. Perfect, right? The business is sellable. It's a transferable assets. It's turnkey, right? Is the term used in the business, which is essentially, here are the keys, don't bother me, right? That's what you want, right? You might not have wanted it up until now, but if you're planning on selling, extricate yourself from the business. Teach others how to do what you do. Put in place policies and procedures that keep them in check and are self-managing, have those key employees, retained, and then make your financials understandable. We've talked about that historic narrative that the buyer is going to look at is based on the financials. They're going to look at those 3 years of tax returns and ask a lot of really intrusive, mean questions about how you've run your business. The intent is to learn from you. The intent is to say, what are the consistent story being told by these financials? And am I at risk buying this as a buyer? This is consistent and it runs itself and it always produces to the bottom line. I'm really confident, right? As a buyer, I'm excited for that. The more inconsistencies I see, the more uncertainty I have. I mean, if I ask you a question and you don't know what the answer is, what am I buying, right? If I'm buying a car from somebody down the street and it's got a weird rattle and I say, what's that rattle? And they go, I don't know. Am I going to buy that car? No, right? If they say, oh, it's the alternator, right? You just have to, tighten it every 100,000 miles. I just haven't done it yet. Okay, they know what they're talking about. Yeah, it's a little weird that there's a rattle. I'm making this up. I'm horrible with cars, so don't worry about that. But, answer those questions, right? So if you look at your business, work with your accountant, do that analysis through the eyes of the buyer, you'll have those answers before they get asked. So then it becomes a confidence game, that they're confident in you and they're confident that they know what they're buying, right? So clean that up. Yeah, so we talked about that. Pay your taxes, right? If you're just showing strong net income, it's an easy sale. If that net income reported, yeah, you pay taxes on it, but man, it's really tantalizing as a buyer to look at a business that's dropping a significant portion of its revenue to the bottom line. So 2 years out, clean up your financials, keep up on capital investments. This is one, right? It becomes very easy if you're like, well, I've listed with a broker confidentially, that vehicle has a rattle. I'm not going to worry about it. I don't feel like replacing it. a buyer is going to step in and they're going to say, okay, well, yeah, the system in place that you're selling is worth $1 million, but I've got to spend 100,000 in the first year on these 3 pieces of equipment. So I can only pay you 900,000. My purchase cost is going to be $1 million. You just don't get the $1 million, you get 900,000, right? So keep up with capital investments. There's another caveat there, going back to that, setting expectations. 50% of businesses don't sell within 18 months, don't let that rattle turn into something worse. So keep your repairs and maintenance, keep everything running fluidly, phase out your role, start identifying buyers. That's a great chance, not to cut out brokers, but if 2 or 3 key buyers and you'd rather pay an attorney, an hourly rate to negotiate with those buyers and get to closing than a broker, 10% of the sale price, that saves you some money in the long run, right? So identifying buyers, making that list in advance, thinking about what the buyer is going to be looking at, answering those questions, it's window dressing, right? It's curb appeal if you're preparing your house. And then when you're in the final year, right? So find your team. The broker is great if you're planning on selling externally. They handle all of the confidentiality agreements. They can help identify the price and present it in a reasonable manner. They can approach, those specific buyers, secure the confidentiality agreement, negotiate with them. So yeah, if it's not a family member and it's not a synergistic buyer, you don't have that short list of potential buyers and you need to bring it to market, a broker is a great person to have on your team. Make sure that they've done business and they do it well, right? A lot of commercial real estate agents, a lot of real estate agents pretend they know business brokerage. They don't. That's a different animal, right? So make sure that you've done it before with similar businesses in your industry and recently. These things change. Maintain full employment. This is a hard one right now, right? Maine, tight labor market. We deal with this all the time. But on the offset to that, that's one of the biggest appeals to a buyer. Right? That buyer's alternative, the ceiling, one of the most daunting tasks for a new entrepreneur right now is hiring full staff. So if you're saying, hey, buy my business instead, I've had these 3 employees, for more than 5 years each, and I've got this core group that's, affirmed their willingness to stay on board. That's a huge asset, right? That's one of those intangible assets that I didn't mention in the list, but what a carrot to dangle in front of somebody. You buy this crack team that's trained and knows what they're doing and has been in place, right? I've actually had purchase prices with a portion of the purchase price put in escrow and given to the employees after a year, right? To say, hey, this business is worth $1 million, but $100,000 of that value is contingent on these employees staying with me. And a portion of that went to the seller and a portion went to the employees. Great opportunity for the buyer. Not great for the seller. They wanted the whole piece. But again, it's a risk. It's understanding the buyer's risk and trying to mitigate that as much as you can to make them as comfortable as possible. Clean up your balance sheet, right? So in an asset sale, you've got your balance sheet, the buyer's buying the predetermined list of assets, but you can be proactive about that as well. If you have non-operating assets on the books, that tractor that's been sitting out there, you can sell it off. If you give yourself enough lead time, you might be able to get a bit of a premium on that. Same thing with inventory, right? If you're showing $500,000 in inventory on the books, but it's only 100,000 that really turns over, buyer's not going to buy $500,000. They don't want the clutter. So maybe start phasing some of that out, buy one, get one, right? Or, post some of the older inventory at discount. You can convert that to the cash, right? The buyer doesn't really care because they're just looking at the 100,000. It's really necessary for operations and that consistency. But you've got old cash sitting on the shelves, right? So may as well start extricating that as much as you can. And then take time off, right? That's the big test of, okay, I've done these policies, these procedures, I've worked with my management team, or I've put these systems in place, and I step away for a bit. And if I come back, is it still working? Or are there opportunities for improvement? Did something happen that I can then address and fix and add a policy to? Right? a lot of sellers don't think about the after, right? So you bring it to market, you do all the things we've talked about. It takes you 12 months to get to a close. You've negotiated the sale price, you've agreed to a little bit of a seller note, you get the check and you walk out of close. What do you do? Right? That business has been your livelihood, your life, everything you've done, dreamt, slept, breathed, eaten, bled about for the last X number of years. Are you okay walking away from it? Right? And I highly encourage any seller to take time to think about that first day, the first week, the first month. Plan to do something, whether that's get out of town, whether it's go up to camp, pick up a new hobby, right? Apply for a job, whatever it is. Put something on your books after the fact, right? And then another advisor actually used the analogy that I love and it stuck with me, but how would you handle it if somebody dyed your baby's hair, right? Because you're probably in the community with the business that you're selling. And you're probably going to be driving by it on occasion and looking in the window and seeing what's happening. And that buyer, is going to change it. They're going to put their own hands on it and do things the way they want to do it. That's okay, right? We have to be able to accept that, but prepare yourself for that. To drive by that first month and say, what are they doing? They changed the shutters from, purple to yellow. This is ridiculous. I'm going to call it. No, it's not your baby anymore, right? They've bought it. They're doing it. So, nostalgia is very common and boredom, more so, but there are a lot of conflicting emotions that come after the sale, and just be prepared for that. And part of that's preemptive as well, right? In that once you get the confidentiality agreement signed and you start discussing with a real buyer, they're going to be asking very serious, potentially offensive questions. You might be offended by the way they frame it, by the way they ask, and the implications around how you run your business. So understand that it comes from a place of fear, right? That they're asking because they're uncertain and they're nervous about it. And the more clearly you can convey the strength of the business that you've created, the systems that you've put in place, the why of what you've done, why you've done what you've done, the easier it is to balance that, right? and react to it positively rather than negatively. So that's all I had for today. Oh, right on time. Perfect. I'd love to answer any questions that you've had, or, our email is here. Kelsey will send around my personal email as well in the follow-up. And we're here for you. I know I mentioned this at the beginning, but it's a no-cost service. There's no limit on how often you use us. I love working with sellers, with buyers as well. We often are referred both and collaborate. For us, obviously, we're tracked on business success. That's what the SBA wants to see. So if the buyer and the seller both succeed, that's wonderful. If the business stays, a business and continues employing people, continues generating revenue, that's all we ask for. And that's our goal through this, is to make sure that transition happens smoothly, effectively, and retains a good business in the state of Maine. Can I answer any questions, or?
Well, so far you're just getting compliments in the chat, but we'll certainly take questions as well. But everyone's saying, great job, great information. It's all super helpful. And yeah, it seems like a lot of information. We recorded it. You can always go back and replay parts of it, and I will send out the slides. So thank you, Raynor. Thank you, everyone, for joining. I don't see any other questions, but we are here. If anybody's got any, feel free to unmute yourself. No? Everybody, Raynor again has done such an exceptional job that no one has any questions. So we'll take that as a win. Thank you all so much for joining us. Thank you, Raynor. Keep an eye out for my follow-up email. It'll likely be tomorrow morning, but I'll start processing those videos now. And otherwise, we'll see you at the next one.